In this video, we're going to look at the candlestick pattern of dark cloud cover. Stay tuned. Hey traders, a very warm welcome to you. Okay, so if you're new to the channel, hello, welcome, consider subscribing. If you're not and you'll come back for the second, third, or however many times it is, hello again, and you will be familiar with this kind of thing we have on the whiteboard here of candlestick patterns. What we do is going to dissect the pattern. We're going to see how valuable it is or isn't, and more importantly, how we can potentially use it to generate a trade idea to use in our trading strategies to make some money from. Okay, so let's have a look. What is it? How does it work? So, dark cloud cover, bit of a tongue twister that one. Bearish pattern, day one, day two, day three. Daily chart, imagine a candle. If you're not familiar with candles, go and check out a previous video I've done on candlesticks, somewhere around here. All right, day one, we have a good solid green candle. So the open, the close, nice kind of trending day. And I guess if we were going to look at day one from a perspective of an intraday chart, that's going to be something like this, right? Pretty much high to low trend day, not quite open to the low, but close enough. Pretty decent. There's your body, there's your tail. All very nice. We know the score with that one. Right, day two, we have this. Now this is where things start getting a little bit interesting. Let's just wipe this off so we can see where we are. Okay, so day two, we gap up, and this is the open. This is the important part here. We gap up above the prior day's range. Now, it don't necessarily have to be above the high, but we're gapping up. We're doing some business, some work at the highs, but we're reversing. And the important thing with this is we're reversing and we're closing, i.e. this part here, in the lower half of the prior day's range. So let's have a look what that looked like on a kind of 2-day chart. Let's put our lovely purple pen here. So day one is, let's assume this is day one, okay? Very, very simplified, right? But that's our day one, and that would make sense. High to low, opens a little bit lower, but that's kind of broadly what happened. Day two, we open up here, we do some business up here, and then we come down and we pretty much close here. So that's our day two, that's our day one. High trend day, gap up, bulls get excited, but at some point in the day, and obviously this time could be shifted, but at some point in the day, things start to change. But the important thing is the midpoint of this day, we close somewhere. We don't necessarily close below the low here, because that would be a bearish engulfing, which is similar, but even more bearish. This is not quite as bearish as a bearish engulfing, but it's still bearish because we've had a situation where bulls have been excited, we've gapped up, we've pushed the highs, we broke out, but we've undone that work and come down and we've closed in the lower part of the prior day's range, upsetting a lot of bulls. And then day three is the confirmation. If we kind of extrapolate this out a little bit, we've got a kind of move that then pushes lower, takes out the low. That really probably should be down here. Takes out the low. In fact, the body probably should be, if I'm being really accurate about it. But you know, in the real world, guys, it doesn't matter. This is never get exactly what we want. I guess the real world, or the best scenario being day three, we have a continuation that breaks through the low of that. But if it doesn't, we're still getting the confirmation. Perhaps it's going to take a fourth day for it to really roll over, but you get the idea. So the point is, day one, bulls are excited, off we go. Day two, they're still excited, off we go for part of the day. Oh no, it rolls over, changes, change in sentiment, supply-demand balance shifts, start to go to lows, start to push down, and the theory is that we're going to get day 4 and 5, 6, 7, 8, whatever it is, resuming a downtrend or continuing a downtrend or starting a downtrend. Right. So first thing to point out, guys, is that this on its own is useless. I've just said all that and you're going like, well, what? I close the video. Right. If you're still here, wait a second. The point is, this just anywhere doesn't make any sense. You will see this many, many times. It's just a couple of candlesticks in a row. The important thing, as with a lot of these candlestick patterns, is where this thing occurs. If this occurs after we've had, we can still see this on the board, we can, let's say we've had a drive lower, okay, and we pull back a little bit, imagine that's that, I've not drawn my candles, we've had that, then we see it roll, we're already want to be positioned short because we're in a downtrend. We already want to get involved in the downtrend. We've already got momentum behind us. We've seen a pullback now. Now we want to find a little bit of a trigger to get involved on the short side. We see this. This is bearish. This is aligned with a bearish condition. Now we can take it. What we don't want to be doing is taking this kind of thing when we're in this kind of environment. Can we still see on the board here? We can. If we're doing this, chopping around, and we see that, completely irrelevant then. You could, and this is the trouble that some people take with the candlesticks. They go, oh look, I've seen a dark cloud cover, I must go short. That is the worst short ever. If you're in that situation where you've got a range band environment, you see that, it's just a range band environment. It's not that bearish. You have to look at it in the bigger picture. Okay, so that's the first point. And something I wanted to add as a bit of a caveat. And it's the same really with all these, with all patterns, guys, all technical stuff. You've got to put it in the context of where we are. You know, you've got to look at it and say, okay, what's the likelihood of this being a genuine turn or reversal, whatever it may be. Right, so how do we position for this? The point of this now is if we saw that in the right conditions and wanted to get short, we could probably take that short on the close of that day and either use a stop above the high. If that's a bit far for your comfort zone, and it might be because it might be quite broad, you could probably get away with kind of doing it 50% of the range or something like that, or maybe even 75% of the range, or maybe a stop above the higher there or close above there. You can structure it, but at some point you want it kind of either, from here onwards, depending on how aggressive you're going to be. That may be a little bit too close, actually, thinking about it. You probably want to go the upper portion of the range. It's worth reducing the position size a little bit and giving yourself that bit more room. Top, if you want to be looking for a decent swing trade and you say, you know what, this could be a really good beast, I want to get on the end of this, I'm prepared to give it a bit more room, a bit more wiggle room, because I might get day 4 or 5 that then rolls over. Are you going to accelerate and get aggressive as you push through the lows? You could. This isn't the most bearish pattern ever, but perhaps if you had something, then maybe you had 3, 4 really big red days after it, you could say, okay, well, now I might want to position it more aggressively on any pullback, and I've already got a little bit of portion on the position, and I've got a little bit of a leg in. Now I can get more aggressive, and I've used this as kind of a tool to start to build a position on the short side. All right, guys, that's dark cloud cover. Let me know your thoughts in the comment section below. If you like this kind of stuff, give it a thumbs up, and I'll see you in the next one. Take care. Goodbye.